All right, we're back from break. I don't know. Let's just get started looking at this first problem, I guess. So let's pull out your problems, and I'll try and read it. Go ahead, bring the overhead up to play here, and I'll try and highlight a few things on here. I'll get it centered in here somehow. And you can go ahead and use the insert because I'm not going to use any of this area at all. The XYZ company expects its dividend to grow at 10% rate this year, 2% the following year, 15% the next year, before settling down to a 7% rate indefinitely. The most recent dividend was $3, and stockholders' required rate of return is estimated to be 20%. Now let me try and show you what some of those things are. The most recent dividend, this pen doesn't work very well. I pull that one out first. That's telling me that div 0 is $3. The most recent means, and pay attention, get this in your notes because this is very confusing for students. But what this means is the dividend was just paid yesterday or something, very, very recently. And so that dividend right there has no impact on any future stock price because I already received it. The check is, they've got the check in the mail. But it is the basis, if you look at the first sentence, for the dividends that will be paid in the future. Because the dividend is going to grow 10% the first year, 2% the second year, and 15% the third year. So those dividends are all based on that $3. So we need the $3, even though it's not part of it. What's happening? Oh, you got a real pen for me. Not showing up very well. Thank you. I thought I forgot to put the microphone on there. I do have it on. Okay. So that we need this. The second part is stockholders. Brian, can you put the insert on? It's like they get, yeah, that's what. The stockholders' required rate of return is estimated to be 20%. That thing right there is telling me that R is 20%. Okay? So we've got all that. Now, Part A says, compute the expected dividends for the next 4 years. And on the exam, that'll be Part A on your question. Because I'm not going to try and trick you. I'm not going to make it for the next 5 years or the next 7 years or whatever. It's always going to be for the next 4 years. I think there's 1 or 2 homework problems that are different than that. But if you want, you can solve all of these problems by just doing compute the dividend for the next 4 years. All of them, you can do it that way and probably get yourself in the habit. So let me switch pens on you here, and I'll see if we can figure out how to do this. There, beautiful. What it's saying is this. I need to know what the dividend will be 1 year from today, what the dividend will be 2 years from today, 3 years from today, and 4 years. Several years ago, I put a problem on the exam that says, find the price of the stock today. That's all I asked for. Well, the students got off. It was just terrible results. So what I've learned to do is rather than say, just find the price of the stock today, you need this information to find the price of the stock today. So I kind of walk you through the problem. So hint, you got to do this before you can do Part B. You got to do Part B before you can do Part C, et cetera. This is kind of the methodology you need. So I'm trying to help you. You might not view it that way. You might think I'm trying to mess with your mind, but I'm really trying to help you. Now, what will the dividend be 1 year from today? Well, remember I said that we just received a dividend of $3? But what do we know about what happens to that dividend? It grows at 10%, right? Well, the way we do that is we multiply by 1.10. and that's the 10%. 1 plus whatever rate it's growing, so it's 1.10. So that means the dividend has gone up to $3.30. So 1 year from now, I'm going to get a dividend of $3.30. What kind of dividend will I get 2 years from today? Well, it's going to grow at 2%. But what is it? What's going to grow at 2%? Is it the $3 that's going to grow at 2%? Or is it the $3.30 that's going to grow at 2%? It's the answer. It's the $3.30. So the $3.30 is going to grow at 2%. And you can write that as 3.37. That's a little bit of rounding. I'm not going to round. And you can either round or not round. It's up to you. But it's really 3.666. If you round, your answers are going to come out slightly different than mine, but I don't care. I'll figure out that it's just rounding error, and whatever works for you, I'm good with. The next one is, it starts out at 3.66, and now it's growing at the rate of 15%, isn't it? So that's 1.15. And I wrote that as 3.8709. And once again, I don't think I rounded. 3.8709. And then the fourth dividend is 3.8709. And what's it tell me? Starting in years 4, it says 15% the next year before settling down to a 7% rate indefinitely. So that means div 4 will be 7% greater than div 3. So each year from that point on, it begins growing at a constant rate. So that's 1.07. And I wrote that as 4.14. What do I got out here? 1863. 1863. Now you can do that in Excel if you want. It's not real hard to do that in Excel. Or you can do it with a little small calculator. So either way you want to do that, I'm good with that. So part A on your exam. Can be there. Part B says, find the value of the stock at the end of the third year. Now, come straight ahead here for a second. Why does it want to know what the stock is worth at the end of the third year? Answer. From starting in the fourth year, the dividend begins growing at a constant rate. So you might make yourself a little, why do they want to know price at time 3? Answer, starting with div 4, the dividends are growing at a constant rate. Do we have a model that allows us to find out what a stock is worth if the dividends are growing at a constant rate? Yes. And the model we have is the one that I said we call the Gordon model, or the constant growth rate model. Now, that one said PV0 is div 1 over R minus G. We want, I'll come back to the override here. We want PV3. The model says PV0 is div 1. If we want PV3, we take div 4 over R minus G. And this, see, that little thing right there is where, if you're going to make a mistake, that's your most likely place to make a mistake. So, how do you put that so it says, remember this, dummy? Don't say that. But make sure you don't forget that. Make sure you don't forget that. Now, remember I asked you for div 1, div 2, div 3, and div 4? Well, the reason why we need div 4 is because we need it right here. So that will be the $4.141863, or $4.14 if you just want to do that. I don't care how much rounding you want to do. Divided by, what did I say the R was? 20%. So that's 0.20. And the constant growth rate is, now remember that this G right here is once it goes constant growth. Remember we had a 10%, a 7%, and a 15%. But we want the one where it's a constant growth, and what one was that? That's the 7% one, isn't it? So it's minus 0.07. And using my vast ability to calculate numbers, and also using my ability to look at my cheat sheet, I know that that's $31.86. Now, do I have enough information to use that buy and hold for 3 time periods and sell model? And the answer to the question is no. I'm going to do this 2 ways. The first way, for those of you that insist to do it the hard way, take good notes on it. For those of you who want the easier way, wait for my second way. But there's always, especially some engineers, that insist on doing it the hard way. So whichever way works for you. I'm not going to... The model I had was PV0. Let me write it down here again. This should be in your notes. Was div 1 over 1 plus R, div 2 over 1 plus R squared, div 3 over 1 plus R cubed, plus PV3 1 plus R. And notice, this is still cubed. It's not to the 4th. These are the same number of time periods. Now, I'm going to plug in the numbers here just so, for those of you that insist on doing it the hard way. Div 1 was how much again? $3.30? And that's 1.20. R was 20%, wasn't it? And then it was 3.366 over 1.20 squared. And the engineers with their engineering calculators want to use the y to the x function right about now. And they plug in y to the x and then take the inverse and, now. Okay. But I'll show you a much better way. Then it's 3.8709 over 1.20 cubed. That's div 1, div 2, div 3, and then the price at time 3 was $31.86 over 1.20 cubed. You can do it that way, and I have no problem. Just, I think there's a better way of doing it. Let me do it doing Excel. If I do this in Excel, I set this up with 5 variables. What 5 variables could I pick to list out here now? Present value, future value, payment, number of periods, and rate. Now, before we had this set of variables and a column of data. Now we're going to have 4 columns of data. So space yourself out for 4 columns of data. And what's going to change is the number of periods will first time be 1, then 2, then 3, and then 3. 1, 2, 3, and 3. 1, 2, 3, and 3. So it's the same thing. We're just going to put this formula into an Excel format. The rate is, what was that, 20%. So it's all the way across, or you can write it all the way across, or you can just put an arrow all the way across like that. Either way you want to do it. Make sure you fill in this whole table. There are no payments. Now, here I'm going to write in symbolically and numerically. So I'll put two things in here. This will be Div 1, which was $3.30. Just kind of crunches together a little bit, but I think if I do with that, you'll be able, when you try and reconstruct it, it'll make more sense. Then this will be Div 2, which was 3.366. This will be Div 3, which is 3.8709. And this will be PV3, which is 4.141863. Ah, thank you. That's why I need people in live class to say, oh, no, dummy. What do I want in there? What was it 3186, right? I'm sorry, 3186. 3186. All right, I ought to pass out tomatoes and just throw a tomato at me when I get it wrong. What you do now is you go to Excel. Well, maybe I can go to Excel. Too much technology here for me. Well, that wasn't here. Here's Excel. And let's make those cells nice and big so Neil can read them. Now, some of you, flip back to the overhead here just quickly. Some of you will go and put this matrix into Excel, and then you'll just click up on this cell and do the calculations. Others, you'll do this on a sheet of paper and then go to Excel and do the calculations. I don't care which way you want to do it. Either way is fine. Here, where are we? Okay. Equals, what do I go? Where'd it go? Okay. Equals, I want the present value, don't I? And what does it ask for the rate first? So that's going to be 20%. The number of periods is 1. The payment is 0. The future value is $3.30. The type is 0, and we'll close the parentheses. I think I got that right. We'll find out here pretty quickly. $2.75. Anybody, you guys match me? $2.75? Don't let me get too far wrong here. All right, can you quickly go back to the overhead? And so up here, this first one is $2.75. Well, I'm ignoring the negative sign here for now. Just ignore the negative sign. Now, let me go all the way through this problem. I know it's a little bit laborious watching me mess with Excel. Go back to Excel here. And I know this, but I want to, so just run it through here. Equals, what do we got in this next one? Present value, parentheses, the rate is going to be 20%. For those of you who are good with the copy function, you can copy this over and do it really, really fast. 20%, and the number of periods is 2 now. The payment is still 0. Future value now is 3.366. Type is 0. Close the parentheses. Enter. And don't bother switching over, but on the table in front of you there, the second column should be now 234. So right in there, 234. And then we go equals present value. The rate is still 20%. Periods is now up to 3. Payment is 0. Future value is 3.8709, 3.8709. Type is 0. And I got 224. Still in there? And then the last one is equals present value, parentheses, 20%. There's much faster ways of doing it than I'm doing here, but I don't want to, if you don't know it, I don't want to try and teach it to you. Number of periods here is 3. Don't forget, that's a big mistake. Some people might make that 4. Oh, why did I put that in there twice? I hit a copy there somehow. Number of periods is 3. The payment is 0. Future value here is 3186. Somebody's bell went off. And close the parentheses. 1844. So you've got on top of there. Let me go back to the overhead here. And so we should have 234, 224, oops, and 1844. Should have something like that. What's the stock worth? Oh, stay with the overhead here. We sum up those 4 values and find out what it's worth. Now, if you're doing it in Excel, it's even faster, because in Excel we'll go equals the sum, and then we'll click on these 4 cells and close the parentheses and tell it to find out what the answer is. Is that the right answer? $25.77. $25.77. So that's what that share of stock is worth. Now, I think it's easier once you set this up to do it like this, because you can copy cells and all kinds of things that make life a lot easier for you. So on my overhead, this is $25.77. So I don't know. You got to be able to do that. One way or the other, you need to be able to fight your way through that. And I will put that problem on there. Now, it doesn't ask for it here right now, but this is the value of the stock today. So let me go to the overhead. PV0 stock today is, what do we say, $25.77? Let me ask a question. What is stock 1 year from today? That's another question I always ask. It's someplace in your homework. Let me go back here and show you why doing it this way is nice and slick. 1 year from today, what's happened? Well, A year from today, I get this dividend, $3.30. And what it asked me is, what is it? 1 year from today means immediately after I got this $3.30 dividend. So what's left after I get this dividend? Answer is, this column disappears. So I'm going to get this dividend, and then be able to sell the stock. But 1 year from today, this would be time one. This dividend 2 years from today is now only one time period away. It's closer. So these time periods have now shrunk. So to answer the question, what is the stock worth 1 year from today, the way we do that is we write down 5 variables. PV1 would be the present value 1 year from today, future value, payment, number of periods, and rate. And the periods would be 1, 2, and 2. We chopped off the first column and shortened everything by one time period. The rate is 20%. The payment is 0. Let me put the future value in symbolically, and then I'll put it in numerically. This is div 2, div 3, PV3, which I got to move something so I can find the numbers. It's at 3.366, 3.8709, and maybe I won't make this mistake again. 3186 was that? I don't think I worked that out. I don't have the number worked out here, so you'll have to work that out on your own. But that's how you go about answering the question, what is it going to be worth 1 year from today? On exams, I almost always ask for that. So you'll have an answer here, here, and here. You add the 3 together, and that's what it'll be worth 1 year from today. So we're making progress. Part D. Let me just kind of flip here and bring it in tightly so we can read it. All right, Part D says, calculate the current dividend yield, or in other words, just the dividend yield, the capital gains yield, and the expected total return for the coming year. This is very similar to what we did on bonds. And let me kind of show you where it's coming from, and then we'll come back and try and answer that. So I got to change on you again, Brian, and go back to the big pen here. You remember this model, PV0, the so-called Gordon model. Div 1 over R minus G. Somebody said solve that for R. Is it possible to solve that for R algebraically? Yeah, it is. And R is going to be div 1 PV0 plus G. R is my total return. Div 1 over PV0 is my dividend yield. And G is known as my capital gains. if I invest in the stock market, how do I make money? Answer, there's two ways I make money on the stock market. One, I get dividends, and two, the price of the stock goes up. And it's really the two of those together is what determines how much money I make. So if I get 5% dividend yield and the stock price goes up 5%, I made 10%. If I get a 15% dividend and the stock goes down 5%, I still make 10%. So it's the sum of those two factors. And that's very important for us here. Now, this is given to us. This is given at 20%. The dividend yield would be $3.30 over $25.77. So the 20% plus the dividend yield equals capital gain, CG for capital gains. This is 20% equals, if I divide this out and leave it as a percent, it's 12.81% plus my capital gains. Think I can figure out what my capital gains is? What this means is what percent did the stock price go up that year? And let's see, it's going to be about 7.19%. So my capital gains is 7.19%. So during the year, I'm going to make 20%. That was given. But 12.81% is from the dividends, and 7.19% is from the stock price going up. And that's what that's asking about. Wonder how you can learn how to do this. I have an idea. There's problems 2, 3, 4, and 5. Maybe that would be some practice there for you someplace. I think so. So I got 4 problems for you to play with. I'll pick one of them next week and I'll go through it in class. But I have something else. I'm not done yet. It's not Miller time yet. Don't get too thirsty yet. I come straight ahead on this now. What I've been doing with you so far is showing you theoretically what a share of stock is worth. The question that most people have is, I don't care about theory. How can I figure out what a share of stock is really, really, really worth? Don't tell me what the theoretical value of this is. Show me a way of actually doing it. In your notes, I should have something in there that, go ahead, put this up. It says valuation assignment on it. I'm trying to do 2 things at once, and I'm always dangerous. It should say valuation assignment on it. And let me just kind of read through this a little bit, and then I'll try and talk about what it means here. There are 2 purposes of this assignment. The first purpose is to give the student some exposure to the methods used by the practitioners, by the pros, to develop an estimate of the value of a company. This is the way you'll see a professional do it. This is what they do. So if you're working in a big brokerage house, they'll come back and say, this is how we think what a share of stock is worth. The second purpose is to expose the students to source of data about individual firms. So I'm going to show you where on the internet I like to go to get data. Now, you might have your own little private source. There's a lot more than just one source of where data is available. But I'm going to give you my favorite places to do these things. So, and if you find better ones that you like, God bless you. Let's continue on here. Put the follow, and you can use the insert because I'll work my way around it. Follow the steps to find information about your company. So, www.yahoo. I like Yahoo. I used to do the whole thing in Reuters, and then about a year and a half ago, Reuters decided to, and that's what I'm going to do the second part of this on is Reuters. Reuters decided to start charging for information. And nobody wants to pay for anything on the internet. Everybody wants it for free. And so Yahoo is the best source of giving you pretty good data about companies. And now I'm doing this on April 29th in 2012. By the time you watch this thing sometime in the future, Yahoo might have figured out a way of charging you. But as it is right now, this is all free. So everything I say is date April 29th, 2012. It might not be working the 30th tomorrow, but it's still, I did it earlier today and it was still working. So we're going to go to Yahoo. Follow through with me. Let me go to the computer now. I'm going to go to Yahoo. Go to the computer if you can switch over. All right. I've gone to Yahoo. Up at the top here, we want to go to, well, no, I'm not, yeah, there's Yahoo. I'm sorry, I'm already at Yahoo. And then we want to go to down the side here, there's a toolbar. This is too small a thing here for me. We want finance. See where it says finance. Can you read this on the monitors? I don't know if this is showing up well. Can't? It says finance. And that's what it says in your notes. So it's finance. I'm clicking right there for finance. All right, come on. Come on. This is always nice about trying to do something. All right, here we go, finance. And then it says, enter the company's ticker symbol. Now, if you don't know the ticker symbol, you can usually type the company's name and it'll come back and tell you, is this the ticker symbol you want? So I always pick on GE because that's a real easy one for me to type. So my ticker symbol is going to be GE. Now, it turns out there are a lot of things that start with G, so as soon as I typed in G, it came in with a whole bunch of other things. But no, I want a General Electric. If you want a General Motors or Human Genome Sciences or Genworth or I don't know what even half of these other companies are. But I want GE, so you just click on GE here. And then it comes back and it gives you some data about GE. So that's the third step in what I highlighted there for you. Then it says use the toolbar on the left. And that's this, is it bluish? Does it look blue on your screen? Yeah, looks kind of bluish there. Scroll down here and there's financial data. You can click on income statement. So if you click on income statement, it'll come back and give you the income statement for annual data for GE. Now, if you want to cheat a little bit, in that package of materials, go back a couple of pages, and you'll find the GE income statement. I printed that out, and what date did I have on that? I can't remember here. That was in March 9th I did that. So March 9th, but the income statement hasn't changed since March 9th, fortunately. So the data in your handouts is the same as what's online here right now. Now, this is the annual income statement. Go back to the screen here. If you click right here, you can get the quarterly statement. But I don't want the quarterly one. I want you to have, where'd it go? Annual one. I want you to have the annual one. So we'll want the annual data. And I want you to make a copy of whatever company you choose. You can pick any company you want. I would try and pick a larger company. If you come from a different country and there's some larger companies in your country that do use the American accounting standards to report data on, you can try and do those also. If not, don't pick GE. Pick, if you work at a company, try the company that you work for or something like that. but find something that be a company that you would like to investigate. So go, all right, so here's the income statement. I find it's usually best to cut and paste that, because if I try and print that out, I get all this garbage on the outside here, and I don't really want that. Is there a printer version of this thing here? I'm missing it here right now. I don't see it. So what I would do is just cut and paste that. Or copy and paste that, not cut. Copy and paste that in the Word and print it out. You find a way of doing it straight?
Print screen.
Where? Oh, print screen. A print screen would do it. But that might print. Does that print all this stuff out here though?
Or you can cut it.
Well, you can cut it. Okay. You guys are better than me. I don't know. Thank you. Somehow, just get to what you want. Thank you. So figure out how to do it, but somehow just print. Don't give me all the advertisements. You don't want all those. So there's the income statement. Now, you can also then do the balance sheet. And once again, you can do it with annual or quarterly balance sheet. And just give me the balance sheet and print screen or cut or copy and paste, however you want to do it, to get what you've got in here. So get a copy of that. Get the income statement and the balance sheet. Yeah, I don't know how long it should take you to do this. Count it in the seconds, maybe. Certainly not the hours. So that's how you get company data. Now, you don't need company data for this assignment today, but we're going to need that week 10. So you might want to just save it in a file, or you can print it out, or do whatever you want. But just get that data, and we'll need it again in week 10. The second part of this statement, the assignment here, is what I'm going to ask you questions about on your exam. Yeah. So yeah, right here, this is it. Follow these steps to find comparative. So I'm on the second page. Just a second, go back to the second page of this evaluation assignment, and then there's the second page to it. Follow these steps to find comparative data. And it says, go to Reuters. You know, everybody wants to pronounce that Reuters, but it's actually pronounced, I'm quite confident I'm pronouncing that right. So we want to go to www.reuters.com. Now, Reuters has income statements and balance sheets, but they want to charge you for it. So bag that. But the comparative data, they haven't started charging for you yet. So I'll hit enter in there. And then under markets, you see this toolbar right here going across here? I want markets. Did I lose you? Are you're good? So it's markets. Under markets, you want stocks. So under markets, click on stocks. And it gives you this crazy advertisement, and continue to Reuters. I don't want their advertisements. That's how they're charging you, I guess. All right. Now, once again, they're going to want a company name or a company symbol. And what should I use for a company symbol? The one I can spell. GE. So I'll go with GE. I think it works lowercase. We'll find out here in a second. I think lowercase works. When you do that, it comes back with a list of, GE has a lot of different things and a bunch of other kinds of things. We want the N company. So we just click on it saying that's the one we want. And then up here on this toolbar, we want financials. So if we click on financials, we can start scrolling down. It gives you a summary of their revenue. I don't care about that. It gives you a consensus estimates of a variety of things. This is where I want you to be from this point on. I want you to get, it says valuation ratios. If you look at the data I gave you, I think that's where I started printing that out. So if you go past the data for GE, you should be able to find valuation ratios. Okay? So you should be able to find those valuation ratios. Now, for this assignment, the valuation ratios are what we want. This is the other ratios, and that's why I printed out the rest of them. We will use week 10. The other ratios we will use week 10. The valuation ratios are what I will ask you a question about on this exam. And I'm going to explain them to you right now. I'm not going to just ask you a question. I'll give you some idea what they mean. Valuation ratios are the way that professionals come up with this is what a company is worth. There are 4 ratios. So get this in here. 4 ratios given to us by Reuters. 4 ratios given to us by Reuters that are used by professionals to come up with the value of a company. Valuation ratios. The first one is this one right here. I got too much of it highlighted here. I'm not steady enough. All right, PE ratio. Anyways, PE ratio. You see where it says PE ratio in your handouts? It's all right. The way you read that is PE. It's a P, capital letter P with a slash and then an E. That's all right. On the exam, tell me PE ratio, P/E, which stands for price earnings ratio. Price earnings ratio. So the first thing that the way they come up with, and by far the most popular, is the price earnings ratio. And what it is, the price is the market price per share. So it's the price per share of the common stock. It's the price per share of the common stock divided by the earnings per share of the common stock. Price earnings, price per share of the common stock divided by the earnings per share of the common stock. Let me just talk a little bit and then I'll get back to this. Is Berkshire Hathaway a high-priced stock? Everybody says, obviously yes, because it's worth $127,000 a share. And the answer is not so fast, my friend. The PE ratio is what determines how high a price of stock is. Price earnings ratio says for every dollar of earnings, that's the bottom, how much am I willing to pay? How much dollars for each dollar of earning? If you have a low PE ratio, that's a low price stock. If you have a high PE ratio, that's a high price stock. What is GE's price earnings ratio? It's 16.34. You notice the other ones, the industry and the sector, are all up in the 20s. They're both up in the 20s. That means that GE stock is a relatively low price stock. GE price. I'm not going to look up Berkshire Hathaway for you, but it's in that range. The price earnings ratio for Berkshire Hathaway is like 16 or 17, something 18, I don't know, something in that range. Berkshire Hathaway is not a high price stock because let's just say the price earning ratio is 20. If the price earning ratio is 20, and let's say for simplicity the price per share is 120,000. The price of 120,000 to the earnings per share of something would give you 20. What would be the earnings per share? 6,000. So for roughly speaking, for every dollar of earnings, you're only paying $20 for the price. And that's not bad. That's a fairly low price stock. A high price stock would be 30, 40, 50 to 1. Those would be high price stocks. A really low price stock would be down 8, 9, 10. Those would really be low. Something in that 16 to 25 range is in the middle. It's neither high nor low price stock. Now, how do we use a PE ratio to come up with the price of a stock? This is what I want you to get in your notes. How would you use? Answer, you estimate the earnings per share for next year. You estimate the earnings per share for next year, and you multiply that earnings per share by an appropriate PE ratio for that company. Take the earnings per share, you get an estimate of the earnings per share for the company for next year, and you multiply that number by the PE ratio, an appropriate PE ratio for that company. An appropriate one. If you think it should be a low price stock, you multiply it by a low PE ratio. If you think it should be a high price stock, you multiply it by a high PE ratio. And if you think it's just kind of an average price, what that stock should be trading at, you multiply it by 16 or 20 or something like that. And that gives you a rough approximation of what you think that stock should be worth. Now, growth companies. Companies that are growing very rapidly, they are usually high-priced stocks. They have high PE ratios. Old, stable companies that are either not growing or shrinking have very low PE ratios. So you have to figure out what's appropriate for this company. But what you'll see in the paper, somebody will say, well, we estimate the earnings per share between this price and this price. They'll give you two upper and lower range. And we think our appropriate PE ratio is this. And thus, here's the upper and lower price range we think that stock should be worth in the marketplace. The most common way that a company value is determined in the marketplace. This is the way pros do it. They estimate the earnings and they multiply it by an appropriate PE ratio. Either a high, a low, growth stock, non-growth, whatever would be appropriate for them. Continuing on. Let's go move on to the computer here. Ooh, it updated on me here. Here's the PE ratio. Now, this is not one of the 4 ways of doing it, but see this little term right here that I just highlighted? What is that called again? Beta. Have we ever used the term beta in this class? Was that week 2? Beta coefficient. What's the beta coefficient of GE? Well, it changes. I get you. The value in front of you there is what? 1.6, and right now it's 1.43, because that's a number that will change. They update that quite frequently. But somewhere around 1.5 would be the beta coefficient. Does that mean GE is slightly above average for risk? It's average, it's way above average, or below average for risk. Average being 1. So this is slightly above average for risk. And GE has proven to be, over the last couple of years, a relatively volatile stock. The stock price has jumped around quite a bit. So its beta coefficient, it always used to be like 0.8, 0.9 for years and years and years. And then about 3-4 years ago, GE did not do so well. And its price has been very volatile the last few years, and thus we see a beta relatively high for a company like GE. That's relatively high. But you can use Reuters to look up the beta coefficient for any publicly traded company. And I remember earlier I said this is publicly available data. This is where you would find it. Reuters has it. So you can look that up. All right, moving on. Back to computer. The second way, oh, wait a minute. This PE ratio, let me go back here quickly. See this thing right here, TTM? That means trailing 12 months of earnings. The earnings picture, so it's whatever the earnings were over the last 12 months. So every month the earnings, the denominator is updated. I don't care if you give me that. Just tell me PE ratio. But that's what you see for TTM, stands for trailing 12 months. So for example, this thing keeps updating itself. The one that I want you to know next, the second way that it is done, is the price to sales ratio. And this is very comparable to the PE ratio, except it's, you call it the P to sales ratio. It's the market price per share divided by the sales per share. It's what the market is willing to pay for $1 of sales. And GE has what, 1.44 in your notes? 1.43 on the screen here right now. Once again, that's a trailing 12 months and it gets updated every month. But it's how much they're willing to pay. The higher this number, the pricier the stock. The high number here, 5, 10 or something like that, would be a high price stock. This is a fairly low price stock once again. GE's not doing real well. The third way that we come up with the value of a stock is the price to book. That is the market price per share divided by the book value per share. Remember that book value thing that I talked about last week? Now, what if this ratio was 1-to-1? It says the market looks out there and it says this company is worth exactly what you're carrying on the books. That's not real good. Something less than 1 means the company is worth less than what you're carrying it on its books. So the market, the book value should be greater than 1. It should be, a company should be worth more in the marketplace than what's on its books, or you might want to consider liquidating. This is one of those measures of whether or not you want to liquidate the company. When this falls below 1, that's not good. And then the last one I want is price to cash flow value. And price, once again, is, well, it's the market price per share. And cash flow, remember cash is king? So how much you're willing to pay for the amount of cash flow per share. And for some reason, on today's computer, it doesn't show it. The one that's in front of you shows it at 9.40, I think, in the notes. So I'm not certain why it's not showing it now. Incidentally, if you went back to price to book, it says MRQ. That's most recent quarter. Most recent quarter. MRQ means, you don't need to know that, but just in case you're wondering. So come straight ahead here now. I've given you 4 ratios that professionals use to determine the market price of a stock. They estimate the earnings, they estimate the book value, they estimate the cash value, and the sales. So they'll come up with the estimate of those denominators, multiply it by that ratio, and do it. Now, on the exam, I'll come up with a question that says something like, what are 4 ways that a professional can estimate the value of a company? Explain